Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Shares of Fiverr are down almost 90% from their all-time high, but is this remote work company really in trouble? I think investors may have sold this off a little bit more than is deserved. So let's go through not only the company's recent performance, but what it said in a recent third quarter earnings report. First of all, I think it's worth looking at the chart. This is Fiverr's 1-year price chart. You can see down 89.5% on Friday afternoon from its all-time highs at about $34 per share. So that's a massive drop for a company like this. Obviously, the company's growth story has maybe taken a little bit of a hit as we've come out of the pandemic. People are going back to work, back to the office. So maybe the freelance work that drove the company's growth during the pandemic is slowing down a little bit, but I don't really think the thesis is broken. Zooming back, you can see that 2020 and 2021 were massive growth years for Fiverr, and the company's not yet profitable. That's always one of the concerns for a company like this, is that if the business slows down and you're not profitable, you're in a really tough position. But they are generating positive free cash flow. So the reason that the company's generating a net loss is because typically of stock-based compensation. That's something definitely to keep an eye on. But from a solvency perspective or keeping the lights on perspective, they are generating positive free cash flow. So that is a positive for the company's long-term survival. I think it's worth looking at some of the third quarter results to see kind of where the business stands right now. You can see here that revenue was $82.5 million, up 11% on the year. Gross margin is 81.1%, 82.8% on a non-GAAP basis. This is always one of the numbers that's amazing to me with Fiverr, is that they have incredible gross margins. Now, I will note that they do not generate revenue the way that they record revenue on every dollar that is spent on their service. They're only talking about the revenue that specifically goes to Fiverr. So any money that goes to a freelancer, if you're getting a piece of art made or a logo, something like that, the money that goes to the person that's doing that work is not flowing through Fiverr's income statement. This is only the fees that they take from the platform. So I think that's worth keeping in mind. Active buyers up 3% on the year. Now, note that we're coming out of the pandemic. I think things are back to pretty much normal, and they're still growing. Not growing like crazy, but we don't have the same pandemic tailwinds that we've had for the last few years. So I think that's actually a pretty positive trend, even though it does probably deserve repricing the stock. Spend per buyer, I think this is a key, up 12% year over year. People are seeing more and more value in what they're spending on Fiverr. So that is a positive as well. Adjusted EBITDA margin, both positive. Again, those are good things for companies that should be growing long term. Financial outlook. Now compare this to what we had in the third quarter, $82.5 million in revenue for the third quarter. Guidance for the fourth quarter, things are going to be about flat on a sequential basis. So that's what we're expecting. Adjusted EBITDA, though, still in that positive range. So I think that's a good thing for Fiverr right now. Here's the other piece that I want to highlight. One of the things that software companies need to do is control their expenses. This has really come into focus over the last 6 months to a year in the market as investors question how much to value growth and how much to value earnings. So companies that are burning cash or generating net losses on an ongoing basis in the name of growing the business have been under pressure tremendously in the market. You can see that Fiverr has really responded by reducing the percentage of R&D and sales and marketing spend per dollar that's spent on the platform. So these trends are both headed in the right direction. In 2019, sales and marketing was 54.4% of sales. Last quarter, 44.9% of sales. Only down slightly year over year, but remember the growth is slowing, so that's probably to be expected. R&D is also similar trend, 28.7% in 2019 and now only 20.5%. So we'd like to see those numbers trending in the same direction. You want to get that operating leverage on the business, but it is good to see that they're at least heading in the right direction as opposed to a lot of tech companies that are still increasing spending, even though the fact that revenue is slowing down. This is the other metric to keep in mind, general and administrative expenses. So this is all completely overhead, come down from 14.7% of revenue to 9.4% of revenue last quarter. So again, headed in the right direction. And you can see as a result, adjusted EBITDA margin is headed in the right direction as well. So is Fiverr Stock a buy? Is this one that I'm interested in right now? Actually, it is, because I think it's a much better valuation than we've seen in a really long time. You can see in this chart, price to sales ratio is down to 3.7. For a while, that was over 50. So we're getting a much better valuation than we got a few years ago. Now, those were aberrations, and we're probably not ever going back to those numbers. But price to free cash flow, even though free cash flow is relatively low right now, is 48. And for a company that is not really in a phase of its business cycle where it's trying to maximize free cash flow, I think that's a reasonable price. So we're getting reasonable prices on a price to sales ratio and a price to free cash flow basis. I just think the tailwinds behind Fiverr are going to be lasting for a decade or more. If you think about what happened during the pandemic, a lot of people learned that they could do work remotely, and they could do work with people all around the world. If you've ever been on Fiverr, you know that there are people all over the world doing projects for as little as $5 or tens of thousands of dollars. So it's a great place to find people, and that's that two-sided market effect that the company is building. That's really something that's durable long term. And I think we're going to see more and more businesses, small businesses, that are built on the idea that Fiverr exists. This is the kind of company that effectively becomes a platform. If you're starting a small business of maybe one or just a few people, and you don't want to hire a dozen people to do things like design and accounting and maybe even building out a business model, that's something that you can get done on Fiverr. So I think the tailwinds are behind the company. We're seeing that with the spend per customer. I think that's really encouraging that customers are spending more and more on the platform. I think that will continue, and even big companies will start using this as more as well. So I think the future continues to be very bright for Fiverr. The stock has obviously been hammered, but it's maybe not in as bad a position as the market is treating it like right now. So I think this is a good investment. It's one that I'm looking to add to my portfolio in the near future. What do you think about Fiverr? Is this a stock that you own or are looking at adding? Leave a comment in the comment section below. Give this video a like. And if you would subscribe to Rive Investing, it really helps out the show and helps people find this content. I really appreciate it, and I'll see you here next time.